Hi, this is Nevin Williams. I'm a mortgage loan officer, and today we're going to talk about income when trying to get a home loan. So, reviewing income and figuring out if income can be used during a home loan application review is one of the most critical components that a loan officer has to go through when trying to verify whether or not somebody's going to qualify for a home loan. Income can be broken down to multiple factors. So, some people get paid commissions strictly. Other people get paid salary. Some people get paid hourly. And some people are self-employed. And then you have some people that are on a fixed income. That's usually going to be retirees or people who are permanently disabled. And every type of income is going to be treated differently and have different rules. So let's first start off with salary. If somebody has a history of working over the last couple of years, or they meet the requirements required for history of employment, if they receive a salary, that salary can be used as soon as it's received. In some cases, with conventional loans, if there's an offer letter that states the start date, the amount of the salary, then that can be used as long as they start the job within 60 days of closing on the transaction. Now, there's other rules and guidelines that apply, but I'm just trying to focus on the income portion of underwriting guidelines. So if somebody is hourly, it's really going to depend if they're starting a new job and their offer letter says that we're going to pay you X amount of dollars per hour, but it doesn't guarantee minimum amount of hours, then in many cases, an underwriter may decide to wait until that hourly pay has been received for 6 months, so that the underwriter can take the total amount that's been made over the last 6 months and they can average it out. The reason is because not everybody is going to work exactly 32, 36, or 40 hours a week. They may have varying hours, 40 hours one week, 38 the next. And so there's really no way for an underwriter to know how much money this person makes unless it's guaranteed. Now, if a job offer letter says that it's guaranteed at X amount of dollars per hour, then it's been my experience that they will allow that and treat it just like as if it was a salary, because they know exactly how much the person's going to make. Now, it starts to get a little more complicated when you start running into self-employed and commission income. So let's start with commission income. Commission income can be considered if it's been received between 12 and 24 months. Typically, an underwriter wants to see 24 months of commission income. If it's less than 24 months, it has to be at least 12 months with the same employer. So between 12 to 24 months, there has to be compensating factors and there has to be other information to support that the person will continue to receive commission income at or above the level that they've been receiving it. So I know that's a mouthful, but what they're really looking for is stability and consistency. They don't want to use somebody's commission income that's received it for 12 months, and now over the next 12 months, it's likely that the commission income is going to drop. If that's the case, the person may not be able to have the ability to repay their mortgage. Self-employed. So anybody who owns 25% or more of a business in mortgage terms is considered self-employed. And for self-employed borrowers, the rules can be very difficult. Now, the guidelines state that 24 months is usually a good indication that a business is going to survive and continue. However, 12 months of self-employment may be considered, but there's this big list of criteria. Number one, it has to be like a specialty field, right? The person who's working self-employed has maybe a certain type of degree to work in that type of business. Let's say, like for a dentist, for example, you have to do many years of school to become a dentist. So if a dentist has maybe 3-4 years of practical experience as a dentist, and now they want to be self-employed, and they've been self-employed for a year, and they can show that they're consistently making positive income like they were making when they were employed before they became self-employed. If they're making the same amount of money or more, and there's other compensating factors, then that may be considered. But I usually just tell self-employed customers, be prepared. The underwriter is most likely going to come back, and they're not going to use the income until it's been received for at least 2 years, because then they know for sure that they can average out to 2 years, and that it's more likely than not that the business is going to continue and not fail. Now, one last thing that I didn't cover, and that is if you're relocating. So if you're a salaried position and you're transferring with the same company, or you're even starting a new job but it's salary, that's usually pretty easy to use that income and consider it to be stable. Same thing with hourly, as long as it's guaranteed minimum hours. Where you start running into difficulty is self-employed. If you're self-employed, it depends on the type of business. So let's say that you are self-employed and you engage in a type of business where you have to meet the customer face-to-face. Like, let's say you fix appliances, okay? And you live on the west coast of the United States, and you drive to your customers' homes in order to fix appliances. But now you're going to relocate to a completely different state that's over 60 miles. Let's say you move from California to Texas, and you're still going to be self-employed and you're still going to be doing appliance repair. Well, the problem is that you don't have a customer base in Texas. You have to start all over from scratch, and because of that, the income you made in California is not going to be considered stable. They're not going to use that income to determine eligibility if you're trying to buy something and you're working in Texas. It's just because they don't know if you're going to have the same success in Texas as you currently have in California. However, if you're, let's say, a web designer, or you're doing some type of business that is remote and does not require that you meet the customer face-to-face in order to generate income, that's different. You could design, webs from your computer at home, whether you're in California or Maryland. It doesn't really matter. That's going to be treated much differently by an underwriter versus someone who has to physically go to a certain location in order to generate income. Hopefully that helps. If you like this video, hit the like, subscribe. Have a great day.